What do you make of the set of the results? Very good balance sheet improvements we are seeing with their gearing dropping from that 46% level the end of August 2009 to around about 10% now on the gearing front.
Yes, I mean, as you mentioned in your interview, there was very good cash conversion, but we need to bear in mind that part of their dividend in the previous period was a scrip dividend, so cash didn't actually flow out. Plus, they also had a rights issue as well, which explains the large reduction in gearing. So, yes, they've done well on the cash conversion, but let's not forget that they had a rights issue as well.
And from an investment perspective, it's a tough environment out there. Certainly, there is a lack of visibility and uncertainty over economic growth and employment in this country.
Correct. Plus, they've had, there's been a lot of talk around labour broking and whether that would be banned or not. We did actually look back. We looked at the stock back in about April, May. At that point, it was trading at similar levels to where it is now, 27.50. At that point, we felt there wasn't enough a margin of safety given the uncertainty. If we look at the results today, we're looking for sort of 225 cents for the full year. So, 92, 95 cents for the first half. If you're looking at HEPS or diluted HEPS, it's not way out of line with what we're looking for. But like I said, there wasn't a big enough margin of safety then, and it looks sort of average at these levels.
Well, Johny, I think we've been debating it for some time now, and I kept asking you the question, are we going to go through the 30,000 point level on the JSE All Share? I think you were relatively dubious about that fact, and so we've gone through it quite comfortably today.
Correct. I mean, we've been talking about it for some time. In the past, we've said, well, there's quite a lot of volatility in the market, so the market could get there. But generally, I think, as you mentioned again in your previous interviews, there is, in our view, an extreme amount of liquidity in the market, and that is moving into emerging markets, and we're seeing that now reflected quite influentially in a lot of our equity and our bonds. Our concern would be that the money is flowing here, not necessarily because it wants to be here or in emerging markets, but it's fleeing the US. US asset managers and UK asset managers don't want to be in their local markets, and they're just looking to place that money anywhere. So our concern is that it's here for the wrong reasons.
Perhaps here for the wrong reasons, but is it here to stay for the medium term? Because that's the big question. And added to that is, how far can it push our market? Are we going back through 33,000?
Well, we got to 30, and the last time I was on the show, probably about a month and a half ago. So we've had a good rally. We could easily get to 33 if this continues. Generally, bubbles, as we saw with, let's say, oil back in 2008, at some point, the share price graphs get sort of parabolic before they correct. So, we could go significantly higher. But in terms of pure valuations and fundamentals, we are struggling to find value both in the equity market and in the bond market. And we think both locally and globally, the market is underpricing inflation at this point in time. And you probably want to be taking a bit of inflation protection through sort of index-linked bonds, etc., rather than playing just the nominal bonds at this point in the cycle. And
what can you do to protect yourself from the stronger rand? 682 on dollar rand a short while ago.
I guess your rand hit stocks are the obvious play. And our portfolios have a number of those stocks. But generally, I think if people haven't diversified their portfolios, they should be taking this opportunity to diversify their rands. Generally, however, what we've seen is people tend to panic and the rand blows out, and then they look to take money offshore. But our advice would be to look to take money offshore at these levels.
And looking at the resource stocks that have obviously been underperforming for some time, given the constraints posed by the stronger rand. Today, they're shooting the lights out. I mean, Anglo-American, you've got up 4%, but it's still below 300 rand. Just your view on these diversified miners, and if they are now starting to play catch up to what we're seeing on the commodity front despite rand strength.
Well, we haven't really liked the diversified miners that much sort of year to date. We've tended to have a lot of our resource exposure either via sugar, which effectively is a soft commodity, or the gold stocks. We have a small position in Billiton, but like you mentioned, Anglo's has underperformed both Billiton and the market year to date, and at some level that would begin to look a bit more attractive. But obviously the rand is going to weigh on near-term earnings for Anglo's.